The triple play, mastering your 3 essential financial statements. Running a business without understanding your financial statements is like playing baseball blindfolded. You might swing hard, but you're unlikely to hit a home run. Smart business owners know that 3 key financial reports, the income statement, balance sheet, and cash flow statement, work together to provide a complete picture of their company's financial health. These aren't just documents for tax season or loan applications. They're your strategic playbook for making informed decisions, spotting opportunities, and avoiding costly mistakes. Let's break down each statement and show you how to use them as powerful management tools. First base. The income statement shows your scoring power. The income statement, also called the profit and loss statement, tracks your revenue, expenses, and earnings over a specific period. Think of it as your business scoreboard. It tells you whether you're winning or losing financially. Most business owners immediately look at the bottom line to see if they made a profit or loss. That's natural, but it's only part of the story. The real value comes from analyzing the details within the statement. Key metrics to watch. Gross profit represents your income after subtracting the cost of goods sold from revenue. Cost of goods sold includes labor, materials, and overhead required to produce or acquire your products. This metric reveals how efficiently you're producing your core offerings. Net income is what remains after all expenses, including taxes, have been paid. This final number shows your true profitability, but don't stop there. Spotting trends and opportunities. The income statement becomes more powerful when you analyze trends over time. Ask yourself these critical questions. Is revenue growing or declining month over month? Are variable expenses like materials costs and direct labor changing proportionally to revenue? Are fixed expenses like rent and marketing costs overwhelming your operations? Which products or services generate the highest profit margins? These insights help you identify which areas of your business deserve more investment and which need immediate attention. Second base. The balance sheet reveals your financial position. The balance sheet provides a snapshot of your company's financial health at a specific point in time. It lists your assets, liabilities, and equity, giving you insight into both liquidity and solvency. Liquidity measures whether you have enough short-term assets to cover short-term obligations. Solvency evaluates whether your company has sufficient resources to succeed long-term. Understanding asset categories. Under U.S. Generally Accepted Accounting Principles, GAAP, assets are typically reported at the lower of cost or market value. Current assets like accounts receivable and inventory are expected to convert to cash within a year. Long-term assets, such as plant and equipment, have longer useful lives and support your operations over multiple years. Intangible assets like patents, customer lists, and goodwill can provide significant value but present unique reporting challenges. Internally developed intangibles don't appear on the balance sheet. Their costs are expensed as incurred. Only externally acquired intangibles get reported as assets. Evaluating liabilities and equity. Current liabilities like accounts payable come due within a year, while long-term liabilities extend beyond the current year or operating cycle. Owner's equity represents the extent to which your assets exceed liabilities. If liabilities exceed assets, you'll have negative net worth, a red flag requiring immediate attention. Remember that book value may not reflect market value. Some companies provide additional detail in a separate statement of retained earnings, which shows stock transactions, dividend payments, and changes from reported profits or losses. Third base, the cash flow statement, tracks your lifeline. The cash flow statement shows all cash flowing in and out of your company. Even profitable businesses can fail if they run out of cash, making this statement critically important for survival. Cash inflows typically come from selling products or services, borrowing money, and selling stock. Outflows result from paying expenses, investing in capital equipment, and repaying debt. 3 categories of cash flow. Operating activities reflect cash generated from your core business operations. This should be positive and growing for healthy businesses. Investing activities show cash used for capital expenditures and investments in growth. Negative investing cash flow often indicates healthy expansion. Financing activities include borrowing, repaying debt, and equity transactions. These flows help fund operations and growth. The bottom line shows your net change in cash during the period. Monitor this closely. Companies must continually generate cash to pay creditors, vendors, and employees while maintaining flexibility to respond to market changes. Reading financial statements. Like a pro, understanding individual statements is important, but the real power comes from analyzing them together. Here's how to connect the dots. Look for consistency. Revenue growth on the income statement should eventually translate to increased cash flow from operations. If you see growing profits but declining cash flow, investigate timing differences in receivables and payables. Monitor key ratios. Calculate ratios that combine data from multiple statements. Current ratio, current assets, current liabilities. Measure short-term liquidity, debt-to-equity ratio, total debt, total equity. Evaluates financial leverage, return on assets, net income, total assets. Shows how efficiently you're using resources. Track trends over time. Single-period statements provide limited insight. Compare multiple periods to identify trends, seasonal patterns, and areas of concern or opportunity. Common pitfalls to avoid. Many business owners make these costly mistakes when reviewing financial statements, focusing only on the income statement while ignoring cash flow and balance sheet health. Profitable companies can still fail from cash flow problems. Comparing absolute numbers without context. A $10,000 monthly profit means different things for a $50,000 company versus a $5 million company. Ignoring timing differences. Revenue recognition rules may show income before you collect cash, creating misleading pictures of liquidity. Failing to investigate unusual changes. Sudden shifts in key metrics often signal underlying problems or opportunities requiring action. Turn your financial statements into strategic weapons. Financial reporting isn't just about compliance. It's about gaining competitive advantage. Your 3 financial statements work together to provide the intelligence you need for smart decision-making. Regular analysis helps you identify problems before they become crises, spot opportunities your competitors might miss, and make data-driven decisions that drive growth. Don't let these powerful tools gather dust in a filing cabinet. Make financial statement analysis a regular part of your management routine. Review them monthly, compare trends quarterly, and use the insights to guide strategic planning. The businesses that thrive aren't necessarily those with the most resources. They're the ones that best understand and leverage their financial position. Master your financial statements, and you'll have a significant advantage in your market. Need help analyzing your financial statements or developing strategic insights from your data? Our team specializes in translating complex financial information into actionable business intelligence. Contact us to discover how proper financial analysis can transform your business performance.